Picking the right stocks isn't about jumping on the latest hype. It's about building a repeatable process that makes your money work smarter. In this video, I'll walk you through how to choose individual stocks with confidence, even if you're just starting out. Let's begin by figuring out how much of your portfolio should be in individual stocks. As a rule of thumb, keep it small, around 5 to 10%, while the rest stays in diversified index funds. That way, you get the stability of the whole market plus the upside of your best ideas. Next, you'll need a strategy. Here are 3 proven ones. First, fundamentals plus technicals. Start by looking at core financial metrics, things like earnings per share, price-to-earnings ratio, and free cash flow. Once you find companies with strong numbers, use charts to time your buy. A breakout above the 50 or 200-day moving average can signal growing investor interest. Second is value investing. Look for solid businesses trading below their intrinsic value. That means a discounted price, a history of profitability, manageable debt, and ideally a margin of safety. Think Warren Buffett and Benjamin Graham. Third is growth at a reasonable price. GARP. These are companies with fast rising earnings but decent valuation multiples. Think of firms growing revenue 20 or 30% annually, yet still trading at moderate PE ratios. Peter Lynch called these 10-baggers for their potential to return 10 times your money over time. Whichever approach you choose, use a consistent process. Step 1. Set your goal. Are you looking for passive dividend income or aggressive growth? Knowing this helps focus your research. Step 2. Run a screen. Use filters to find stocks that fit your criteria. PE under 18, PEG under 1 for value or earnings growth north of 20% for GARP. Free tools like Yahoo Finance, Finviz, or your brokerage screener work great. Step 3. Dig into fundamentals. Check annual reports, earnings call transcripts, and metrics like return on equity, debt to equity, and free cash flow. Don't skip management commentary. If leadership has a clear plan, that's a good sign. Step 4. Evaluate the chart. Is the stock above its key moving averages? Are trading volumes picking up? That can confirm investor interest and reduce the risk of buying into a falling market. Step 5. Check quality. Look for a competitive edge. Branded moat, unique technology, or recurring revenue. That's what separates average companies from exceptional ones. Step 6. Watch institutional activity. If hedge funds and pension plans are building positions, that's often a sign of confidence. Step 7. Scale in. Instead of buying all at once, break your purchase into 2 or 3 chunks. That could mean buying a third today, a third next month, and the rest later. It lowers risk and smooths out price swings. Step 8. Hold with patience. Give your picks at least 3 to 5 years. That time frame allows fundamentals to matter and trends to play out. Let's walk through an example. Imagine you want growth and run a screen for PE under 20, PEG under 1, earnings growth of 20% or more. You land on a software company with rising sales, strong cash flow, low debt, and recurring revenue from subscriptions. The chart shows a breakout above the 50-day moving average on higher volume. Analysts and institutional investors are increasing their positions. You decide, buy 1/3 now, 1/3 in 4 weeks, 1/3 in 8 weeks. You plan to hold for 5 years unless something fundamental changes. That's it. You used a strategy, did your research, validated with charts and investor behavior, and invested with discipline. Now let's clear up some common rookie mistakes. First, avoid chasing the latest viral stock. If it doesn't fit your process, skip it. Second, don't react to headlines. Stick to your analysis. Third, watch costs. Trade commissions or high fees eat your returns. Fourth, don't overconcentrate. Never bet your future on a single stock. Diversify that small portion of your portfolio across a handful of ideas. Here's your quick recap. Keep individual stocks to 5 or 10% of your portfolio. Choose a clear method. Value, growth at a reasonable price, or fundamentals plus technicals. Screen for candidates. Check financials, charts, business quality, and institutional interest. Scale in, hold long, and avoid emotion. That's how beginners become smart stock investors. If you follow this process, small allocation, strong fundamentals, disciplined entry, long-term holding, You're already ahead of most people trying to time the market. Comment below which step you want us to dive deeper into next, or what other investing tips you want to see on this channel. Meanwhile, hit like if you found this useful and subscribe for more simple money content that actually makes sense.